So yeah, we are the multi-factor investing team. So we're going to be going over our factor-based portfolio optimization. So I'm Nate.
I'm Vincent Madden.
I'm Kshitish Bhandari.
So yeah, we're just going to really quickly go over some pretty necessary background, and then we'll of course get into some performance and some pretty cool applications of the results that we got. So starting out, the most important, this is the backbone of basically the entire presentation, is the Fehmer-French model. Specifically, we use a three-factor model. But Fehmer-French in general is an extension of the capital asset pricing model, which is, of course, very well known. Capital asset pricing model aims to essentially explain excess returns with one single factor, beta, as we would refer to it as. Fehmer-French extends on that, specifically the three-factor model extends on that with two more betas of its own. So there's an equation on the screen here that's maybe a little intimidating, but if you look at the right-hand side specifically, you'll see sort of on either end there's an alpha and an error term, which are sort of trivial for our purposes, certainly trivial for purposes of explanation here. The really important things that I want to divert your attention to are the beta factors in the middle. So there's three of them, as I said, and the leftmost one, the market risk beta, is exactly the same beta that we would talk about if we're talking about beta in the context of a capital asset pricing model. So this is market risk beta. It's a measure of how sensitive an equity is to movements in the overall market. So this is something that we're familiar with. If I told you that a stock had a market risk beta greater than 1, then you would expect that it would be more sensitive to moves in the market. Then the Fehmer-French three-factor model extends on this with two betas of its own. The first of those being size. Luckily, these are both fairly self-explanatory. Size beta is a measure of how much a stock behaves like a small cap stock versus how much it behaves like a large cap stock. So with a size beta that is greater than 0, you would expect that a stock behaves more like a small cap stock in terms of its returns than it does a large cap stock. And then very similarly, we have the value beta, which is, again, how much a stock behaves like a value stock versus how much it behaves like a growth stock. In terms of size beta, obviously we have market capitalization is a pretty easy measure for something like that. For value, as a simple proxy, we use book to market, with obviously a high book to market would indicate a value stock. So multi-factor investing, we've employed a model. Right now we have these three factors, these three beta points that we would like to invest with respect to. We have three levers that we can pull, exposures that we can adjust. The question then is, how can you actually invest? How can you effectively invest based on these three factors, get above average risk-adjusted returns, and actually hopefully be able to explain some portion of those returns? That is the goal here, with a special emphasis on explainability, right? We're not looking for just blind high returns. We're looking for a model that produces returns that we can explain. The latter half of this slide then is essentially our end-to-end workflow of this portfolio optimization sort of in a nutshell. So at a high level, we have really two inputs. Raw data, this is just return prices from S&P 500 equities, and then a specific set of three beta points. So these are the three beta points: market risk, value, and size, one for each. And these are presumably the three beta points that we would like to use to build a specific portfolio with average exposure. So if you choose some, for this purposes of the explanation, it doesn't necessarily matter right now what those three are, but the idea is that you input 3 and you output a portfolio with average exposures at or near those targets. So you've input 3 beta points. What happens from there essentially is we regress 3 years of market data, and we fit the equities in the S&P 500 with our own sets of these beta points. So that when you input 3 target beta points, we can actually feed that into an optimizer that will then create a portfolio with target exposures, average target exposures at the three that we specified, and then of course rebalance those monthly to ensure that they stay at those target exposures. And then pretty simply we test. For this we have a 5-year testing period. It's January of 2020 to December of 2024, and the idea is just, well, how does this specific portfolio with these specific exposures perform? So we have a system where you can input 3 beta points and get as an output a portfolio with average exposures at those beta points. I think the natural next question is, how do you choose the best 3 beta points, right? We have the way that we break up the beta points. There's over 1,100 different combinations of beta points. The idea is, how can we choose a specific set of 3 that is, again, has above average risk-adjusted returns and hopefully can explain some portion of those returns. And the way that we do that is with something that is very closely related to something called a bandit algorithm. So the easiest analogy here on the left side of the screen is the slot machines. So if you can imagine walking into some random casino, you pull slot machines, 5 of them, over and over and over again. You're paying attention to returns. And after some arbitrary number of returns, of pulls, you decide, okay, I think on average, machine 2 and machine 4 are paying out better than the rest. And so now you're just pulling these two, right? We don't worry about the other ones. They're not paying out as well. We're just going to pull these two. And again, after some number of pulls, we decide, okay, overall, machine 4 seems to on average pay out better than the rest. And this is at a simple level, this is exactly what we're doing, but you can replace slot machines with sets of 3 beta points. But it's the exact same sort of search, explore, and adjust, where we're testing beta points, seeing how they do, and then adjusting accordingly. A lot of times in the context of a bandit algorithm, you'll hear the phrase exploration and exploitation. That is exactly what we're doing. We're exploring different beta points, and then quite simply, we are exploiting the best set of beta points with the best payout as defined by a risk-adjusted return by building a portfolio that is tailored to those target exposures. Quick note on the bottom of the screen, Sortino ratio is a specific measure that we're maybe more focused on in terms of risk-adjusted return, which is very similar to Sharpe ratio. It only penalizes downside volatility, but you'll see both on the coming slides.
Yeah, so Nate talked about the overall idea of how our bandit algorithm works, but if we want to get a bit more specific, what do our actual periods look like? So you go all the way back to 2014 for our standard period, and you're going to train regression from 2014 to 2016 for the validation period of 2017. Then for 2018, that validation period, you're going to train regression on 2015 to 2017. Then for 2019, you're going to train on 2016 to 2018. You're going to combine these 3 points to get your validation period of 2017 to 2019. And then you're going to get the Sortino ratio out of that validation period, and you're going to rinse and repeat, and you're going to try your new beta combination, and you're going to keep repeating that until you finally have a value that you call optimal based on the Sortino ratio maximization. Now, once you have that optimal beta combination from the validation period, you can now backtest that on 2020. But as Nate said, our period is not just 2020, it's 2020 to 2024. So what are you doing for the next 3 years, next 4 years? Well, you literally just do the exact same thing, but with every year indexed one singular year. So it now turns into a validation period of 2018, 2019, 2020. So it's just one extra year of data. And the idea behind doing that is there's 2 main reasons. One, there's no reason to ignore this extra data. You now have an extra year to work with. It makes sense to try to make your model more accurate by using that extra data. And additionally, overfitting is obviously going to be an issue with any portfolio that's based on historical data. When you have this cross-validation, this walk-forward strategy, that enables you to have a diverse set of information, a diverse set of beta combinations being plugged in, and it's going to significantly reduce overfitting. As mentioned at the bottom, this prevents data leakage, this prevents look-ahead bias, so that typically also will make it even more prone to overfitting. So a system like this, a walk-forward system, does do well to prevent this. Now, we talked about our model and an overview of what are we plugging in, how it's working, but what does the performance actually look like? What is like the end goal of this model that we have? Well, if you start off with a basic ROI graph, you can see the cumulative returns from the period of 2020 to 2024. So a few key things here. You can see, of course, at the top, all the way at December of 2024, we do have a slight amount of outperformance versus the S&P 500. That's obviously a good sign. But you do see some things on here that, eye test, you might be able to see. You see some significant drawdowns compared to the S&P 500, and you do see possibly some increased volatility. Well, when you look at these drawdowns a bit more specifically, the main one that jumps out is the 2020 crash, where you can see our portfolio did, unfortunately, dip down a little bit past what the S&P 500 did. But then, on the other hand, in the bear market of about 2020 to maybe mid-2023, you can see how our optimized portfolio did not dip down nearly as much as the S&P 500, which is going to be a good sign, and that's going to overall reduce downside volatility and help us optimize our Sortino ratio. Now, what the actual performance metrics look like is much better than just blind graphs. You can see we do have a good amount of cumulative return outperformance, and that does translate to a bit extra of annualized returns. Now, on the other hand, you do see a small amount of increased volatility and then a small amount of increased downside volatility. So you might say, well, okay, you just have almost a leveraged portfolio where it's a bit more return-based, but it's also more volatile. Well, the key thing is the Sharpe and the Sortino ratio at the bottom. You can see we have improvements of about 0.02 of Sharpe ratio and an improvements of about 0.09 on the Sortino ratio. And what those 2 numbers translate to is that our optimized portfolio is gaining more risk-return trade-offs than the S&P 500. So for each unit of risk that we add, we're going to have even more outperformance than the S&P 500, which is exactly what we're going for, because what we want is a portfolio that is maximizing Sortino ratio. So when we are beating the S&P 500 in Sortino ratio, that's exactly what we're going for. And for anyone curious, The actual beta points that we rebalance to for each year are the ones as shown. So what that means is for 2020 per se, we rebalanced every month to a 1.3 market risk factor, a 0.2 size factor, and a negative 0.2 value factor. And then it just extends to 2024. Now, we have the performance, we have the model, but our main thing is explaining returns. So what does this look like when you try it on another market? Well, the main thing here is this is the exact same inputs, the exact same flowcharts that we showed previously, with one difference that our raw data is no longer the S&P 500 information and the S&P 500 equity information. It's now based on the Nifty 50 market, which is India's largest 50 equities. Now, why we are doing this is we want to see that if you strip away all the noise, all the idiosyncratic gains of the S&P 500, how well does a multi-factor investing framework really explain your return stream, and how much does it translate into different regimes? So regime changes is a really big thing because in the US, these federal interest rate adjustments, these economic indicators, they're all going to have big implications on US equities. So these changes do somewhat ripple into foreign markets, but the main thing to consider is somewhere like the Indian market, the NSE exchange, it's going to have much less of these ripple effects, and it's not going to be particularly correlated to the S&P 500. So how do our portfolio returns correlate if we ran it on this Nifty 50 market? Well, we would expect that the indexes in and of themselves would have pretty low correlation, and then we're going to expect that once we're rebalancing yearly, it's going to have higher correlation. Then once we're rebalancing monthly, it would have even higher correlation.
So Vincent went over the idea of cross-market correlation. Now we'll see the results. So before moving to the results, we'll see how the Nifty 50 and S&P 500, they both correlate without modeling. So we can see the correlation index is 0.07, which says that both markets barely move together because both the markets share different policies. They have different governments, different investor behaviors. So basically, Nifty 50 and S&P 500, they both live in different financial worlds. So we'll see how does our optimized portfolios on both the markets correlate. So what we did was instead of comparing both the markets simply based on the returns, we put our optimization model on top of them, and we saw that we got a correlation index of 0.73, which is very high, considering both the markets move completely opposite to each other. This shows that our optimization model is not just picking random stocks, and it's actually selecting the portfolio based on risk-adjusted factor returns. So in the next step, we increased our rebalancing frequency instead of going rebalancing the portfolio once a year. We tried it once a month, and it increased our correlation index from 0.73 to 0.85. And this shows that more frequently you realign your portfolio, more similar returns you're gonna get. And this says that our returns are more repeatable and structured. And when I say repeatable and structured, we mean that if we put optimization model across different time and across different markets, we'll get same results and it's the same behavior. So our performance also comes from the systematic factor exposures. It's not just taking random stocks and putting some random noise. So how do we know that our the correlation demonstrate this is that if we get high cross-market correlation index of 0.85 on monthly rebalance portfolio and 0.73 on yearly rebalance portfolio. So this says that our returns are basically driven by underlying factors and not Indian and US index-specific performances. Also, our optimization model is doing a good job at filtering out the company-level macro risk and country-level macro risk, and it's basically leaving behind pure factor-based returns.